Have you ever placed a trade and felt completely confident and then watched the price go exactly against you? You were not unlucky and you were not wrong. You were just simply on the wrong side of something bigger than you. And today I am going to show you what that thing is called. It's simply called supply and demand. And it is the reason why the banks and the institution moves the market the way they do. Every single price movement you've ever seen, every rally, every crash, and every reversal started from a supply or demand zone. In the next 30 minutes, I am going to teach you what supply and demand zones are, why they exist, and how you can identify them on any chart, how to draw them correctly, and exactly how to trade them with real explanation on Euro USD, GBP, or gold, any of these pairs. This is not beginner theory. This is how the market actually works. Stay with me in the next 30 minutes and you will never read the chart the same way again. Let's ride into it. Before we look at any chart, you need to understand what supply and demand actually is, because so many traders draw zones on their chart without truly knowing why the market goes back to those areas. So let me explain it properly. Supply and demand is the most fundamental force in every market on earth. In any market, whether it's food, real estate, or forex, price goes up when demand exceeds supply, and price goes down when supply exceeds demand. This is not complicated. This is economics. Now, in forex, who controls supply and demand? Banks, hedge funds, central banks, institutions. Those players are moving hundreds of millions, sometimes billions of dollars through this market every single day. And when they place those massive orders, they leave footprints on the chart. Those footprints are called your supply and demand zones in the market. Here is the key insight that most retail traders never understand. When a big institution wants to buy or sell a huge position, they cannot do it all at once. If they try to buy $1 billion of Euro USD in a single order, they would move price so much against themselves that the trade would be unprofitable before even they get fill in their own position that they want to place in the market. So what do? They accumulate their position in stages quietly in a tight price range, often during those slow sections like the Tokyo sections. Then once they have built their full position, price explodes away from that area. That explosion is called your impulse move. And that quiet accumulation areas, that is the zone they will actually return to before they will make another impulse move. So why does price return? Because some of their order were never filled, and when price comes back to that zone, the institution is waiting to complete their position. That is why zones works. This is not magic. This is order flow. Now let me show you the two types of zones and actually what each one looks like on the chart. A demand zone is an area where buyers overwhelmed sellers. Price fell into an area, consolidated briefly in a tight range, and then launched strongly upward. That tight consolidation area before the explosive upward move. This is your demand zone. Think of it as the area where institutions finish buying. When price returns to these areas, those buyers are still there waiting, and price will automatically bust up again from these areas. A supply zone is the exact opposite. Price was rising. It consolidated briefly at the top and then dropped sharply. That consolidation areas at the top before the sharp drops. is your supply zone. Is where institutions finish selling. When price return to those areas, those sellers are still waiting again to drop the market the more. The four most powerful zone patterns you will see are rally-based drop, drop-based rally, rally-based rally, and drop-based drop. Let me explain each one. Rally-based drop: price rallies up, consolidates in a tight base, then drops sharply. The base is your supply zone. This is the most reliable supply zone pattern. Rally-based rally: price rallies briefly, pauses in a base, then continue rallying. This is a continuation pattern. The base is a demand zone, just in the direction of the trend. Drop-based drop: price drops briefly, pauses, then continue dropping. The base is a supply zone in the direction of the trend. Now, I want you to write this down on your journal. The strongest zone, the ones with the highest probability, comes from rally-based drop and drop-based rally. Those are reversals. Those are where institution money changes directions. This is the important ones you need to know. The rally-based drop and the drop-based rally. This is the highest probability ones. Not every base on the chart is worth trading. This is the biggest mistake I see a lot of these beginners make, from the TikTok beginners and the ones that are learning through TikTok or other social media platforms. This is the biggest mistakes I see they make in the market. They mark every consolidation as a zone, and then they wonder why their trades fails. Let me give you my own 5 checklists that you can always implement in all the whole chart, in your chart, to be seeing good quality trades to trade. At least it must meet 3 of these criteria before you can be able to take any trade from. So number one, the base should be very, very tight. The consolidation before the impulse move should be very, very narrow. Like, the consolidation should look very tight and very narrow. Like, it should show like this is a really consolidation before you see any impulse move. Ideally 2 to 3 or 4 or more consolidation. Like I said, the tighter the base, the more concentrated the institutional order will. A wild messy base means the order are split out and the zone is weak. Number 2.2, the impulse move must be stronger. Number 2, the impulse move must be stronger. The move away from the base must be exclusive. Like, the move away from the base must be exclusive. You must see large candles and a stronger momentum and a little hesitation. Like, you will not even have anything to say than hesitating to even click your sell or buy. If price crawls away slowly, the zone has a limited institutional backing. If price crawls away from the zone slowly, you will know it has a limited institutional backing. You want to see price leave the zone like it was shoot from the cannon. You want to just see the price moves very fast, like leave the zone after a tight consolidation. This is number 2. So number 3.3 now, the zone must be fresh. The zone must be very, very fresh. A fresh zone is the one that price has not returned to since it was created. The first time price revisits a zone is the highest probability. I hope you're journaling down all these my 5 checklists I'm giving to you. Every subsequent retest weakens the zone because the resting order are being filled. Each time after 2, 3 or 4 retest. Like after you see 2 or 3, 4 retests in a zone, like come and test it 1, 2, 3. Reassure that all those tests that are being tested in that zone is going to be likely, the zone is likely going to be depleted, is likely to be disrespected. The market will just break it off, anything you can call it. So always be reassured whenever you see 4, 5, 3 retests in a zone. Always know that the zone can be disrespected. Number four, the higher time frame alignment. A supply or demand zone on the daily chart is significantly more powerful than the one on the 15 minutes. If you see a supply zone on the daily time frame, always be reassured is a powerful setup for you. Always check your higher time frame always check your higher time frame first. If you see a zone on the 4 hours time frame that aligns with the one on the daily time frame, that is a premium setup. That is a very, very premium setup. The more time frame that agrees, the stronger the zone. The more time frame that agrees, the stronger the zone. Because if you see a demand zone on the monthly time frame, it's stronger than the one on the weekly 1 hour on 1 day. If you see a demand zone on the daily time frame or 4 hours time frame, it's stronger than on the one, more than the one on the 15 minutes 1 hour. You understand? So always align your supply and demand zone from the higher time frame perspective. So to be honest with you, this number 5 is going to be the one I really need to take my time and say it very slowly, because this is the most important one I really want you to write most in your journal. Number 5, the impulse started from a significantly level. Like the impulse must start from a very higher time frame level. Like you can see this Euro USD, this impulse is starting from the higher time frame level. That since you've been seeing, this impulse is coming from a very higher time frame level, and you can see we have every characteristics to take this trade whenever these retest come back to this zone, because you can see from here, from this angle here, we are seeing some retest. We were expecting some retest back to this demand zone before we can take any trade, because you can see large candles. You can see the impulse spiked off like something like shoot out from nowhere, and you can see the consolidation are tight, because this is a very stronger example I really needed to give you with this Euro USD. You can see all the whole thing I really needed is aligned. So if I should see the retest from here, I can now hesitate that clicking my sell button for this on this Euro USD sell. If the zone formed right, at a previous higher highs or a swing lows, a key or resistance point, and you can see this demand zone now is coming from a key and resistance point. It's coming from a resistance point at this place. It's coming from a resistance point or a Fibonacci retest. If I should bring out my Fibonacci from here and count it from here, you can see that we are seeing the 6.5 and this thing aligning at this premium zone. So whenever you see all this alignment, know that you are really good to go to take a very premium setup. When you add the Fibonacci and your demand zone together, that adds confidence and increases probability. Zones that form in the middle of nowhere without confidence are very low quality trades. Like for example, if now we wanted to take this trade from this middle of nowhere, there is no confidence holding this place now. It's not a higher probability because there is no confidence guiding this this place now, because this is a very low probability. Honestly, this is a low probability because it's not coming from anywhere. But you can see above here where we placed our order. You can see this had a lot of confluence. This is a very strong resistance point, and this a demand zone. And also you can see a large candle breaking to the downside from this angle, breaking all these impulse move, breaking them, showing that a lot of disrespecting is being on this market. You can see it here, you can see very clearly, breaking all these lows, breaking all these lower highs, breaking them, moving to the downside. This is a very strong higher probability. When you're taking all this trade, use of Fibonacci. I've talked about Fibonacci videos, so go, if you've not watched it, go to my channel and watch it. I've also talked about support and resistance zone, so search in my channel, you'll also see it. So all these things, if you add it up, you will see a lot of confluence in your trading career. So I guess I've said a lot about supply and demand zone. I guess I've literally give you a lot of work about supply and demand points. And always remember that supply and demand zone are not like support and resistance zone are not like supply and demand zones. These are different symptoms in the trading industry. These are very, very different things when it comes to trading. Supply zones are where you can see a very sign that the sellers or the buyers are in a very strong position to take sell or buys from those angles. You understand? If support zones are a very big zones that are coming from maybe from your monthly time frame or from your weekly or daily time frame, those are support zones. Like this place now, this is a very strong supply zones. When we go to our daily time frame, this is a very strong support point that the market is actually bouncing off. You can see it very clearly at this angle. This is a very strong support zone that this market is bouncing out from. So it's likely that Euro USD is going very, very to the downside. It's likely that Euro USD is coming to at least 1.1 or 1.116 thousand. So this is the place that I'll be anticipating Euro USD to come down to. So I guess I've talked a lot about supply and demand zone today. So I guess we've learned a lot. So go and implement all this, and don't always forget to align your trade from the higher time frame, and also don't forget to use your Fibonacci retracement. That is very nice. And also I talked about the first pull. This first pull of every retest, I guess I'm going to make a video about it and still at least enlighten you guys about this first pull. I said it on my video, I remember. So if you've not really subscribed to this channel, I guess I don't need to convince you to subscribe, because we're going to be dropping a lot of videos in the future to teach you, to even enlighten you more as a pro or as a beginner, to give you a best trading education for free in this YouTube channel. So don't forget to subscribe to the channel, like, and also comment on this channel to get more reach out to other people. So also I noticed that a lot of people that are watching my content are not literally subscribing to this channel. So who is this 35 point people that don't subscribe, that don't want to subscribe to this channel? I guess you should really subscribe to this channel now, so that we'll be getting some reach out. So I'm done with my video. I'm done with my supply and demand zone video. I guess you literally learned a lot from it. So peace out, guys. I love you, and I will see you in my next videos. Peace out.